Susan, you guys had an amazing report looking into the different kind of debt all over the world. And I want to point out, we have a chart we can pull up here, that since 2008, the total global debt has grown by 3/4 to all the way to $169 trillion. Susan, who is the biggest offender here? What country added on the most debt?
Well, we've got two different things going on. One is, of course, a growth in government debt, which does explain the largest portion. But then less noticed has been the huge growth in corporate debt that we see. And when you look at the corporate debt landscape, really all countries have put on a lot of company debt, but China really stands out.
Yeah, well, one of the things, Susan, a couple of things I took away from this is, number one, the amount of corporate debt, as I understand it, has doubled in relation to GDP. But also, China accounts for so much of the growth in the debt. It started at a very low number, but it's right up there now.
It did. It really, I mean, its corporate bond market went from virtually nothing 10 years ago to $2 trillion. So now one of the largest in the world. And as a share of GDP, Chinese corporate debt is up at 163%, which is really higher than any other country in the world, except for financial centers.
So, Nathan, with your expertise, I mean, I don't have to ask the obvious question. When does it burst? What happens? What's the implication? What's going to be the trigger?
So this is the number one policy, well, I should say the number one domestic policy challenge for the Chinese and for President Xi, is they've seen an extraordinary increase in domestic indebtedness, particularly in the corporate sector, that has huge implications for the sustainability of growth in the economy and the banks. And they're trying to slow the growth of debt and leverage and credit. And how do you do that in a way where you're slowing it down just enough to also hit the 6.5% growth target? And this is the tension that the Chinese authorities deal with on a day-to-day basis.
Susan, from your study, how much of this is overall increase in amount of money owed, and how much of it is a shifting actually from bank loans into capital markets? Because I've heard in other places that increasingly we're essentially shifting the risk that had been the banks. We fixed the banks, now we got a lot of reserves there, but now it's being shifted over to debt capital markets.
Well, that's part of the trend, definitely. So because banks have been restructuring and adapting to new regulations over the last 10 years, growth in the bond market has really soared. But that said, it's not just, I mean, there is a net increase. So overall, corporations are more leveraged, more indebted today than they were 10 years ago. So both have grown, but in particular, the bond market has grown.
True, but it's where it grew has been really interesting. You guys pointed out that the non-financial corporate debt issuance has been very strong in triple Bs. Tell us your finding on that.
Yeah, so there are a couple risks in this growth in the bond market. And one is just that credit quality has slipped. So we've had 10 years of amazingly low interest rates, and that's enabled all sorts of companies with, frankly, weaker credit ratings to borrow money. So about 22% of overall debt outstanding in the U.S. or corporate bonds is high yield. And then when you look at investment grade, you find that triple B, according to S&P, is the largest chunk of the investment grade debt. Well, that's just one notch above junk bonds. So overall, we've seen a downward migration in the credit quality of companies that have been able to issue bonds.